Just another little note for the actuaries and consultants in the room. It's another little break for you. Please feel free to go grab a cup of tea. We'll be done in about 2 or so minutes. The sequence of events we saw in the UK could not possibly have been predicted. The retail distribution review set out clear aims, and we could see the impact to the advisor population. But the regulator was only just getting started. It was the subsequent thematic reviews after RDR that really hit the industry hard. Platforms, advisors, fund managers, and yes, consultants. We even see that shift in the regulator approach now moving across the EU passport via the MiFID II regulation. The real hitter was the FCA asset management study, particularly the interim report that was published 18 months ago. It made great criticisms of the investment consultant industry. They have found themselves not immune from the drive for transparency. So how did consultants get here? Well, we have to begin with the marketing mix. We've got to go back to 48, Professor Coulton. Then you've got Professor Neil Borden through the 1950s. And for those who have studied management, will probably recall Jerome McCarthy's book, published in 1960. It set down the 4 Ps: product, price, place, and yes, promotion. By 1981, we had the Booms and Bittner model, which added a further 3 Ps to the first 4. People, physical evidence, process. As a generation of Reagan and Thatcherite Ivy League graduates entered the industry, that culture of the management consultant took hold. It is no surprise, therefore, that their colleagues in the investment management side of the business adopted the same language when it came to assessing funds. Set down 1978, Russell's, one of the first. They launched their London office in 1981, quickly followed by the likes of Mercer. And yet, in the interim asset management study, the FCA criticised the aggregation of price into these multi-P models. In some cases, it found that investment consultants had only weighted 5% of their overall score towards price. They said that they could not possibly have enough focus on value for money when making recommendations to their pension scheme trustees. In this instance, they felt it had diluted the value of that process. The lesson for us is, instead of integrating price into your assessment of fund managers, if you consider it a separate hurdle, then you avoid buying any fund at any cost. And indeed, in Chapter 8 of that asset management study, the FCA continued to levy its criticism. It also questioned whether consultants and fund rating agencies should operate outside of the fiduciary perimeter, that they should be unregulated for the fund recommendations they were making to the scheme trustees. It criticised the relationship between the scheme trustees and their ability to challenge back their consultants. It challenged the technical competence of the scheme trustees to even select the consultants who were giving them advice. Lastly, it questioned the oligopoly that had occurred within the UK also happens in the US between the big 4 firms. The real blow was when the big 4 submitted their protest to this report. It was called the Undertaking in Lieu, the UIL. And they said, no, FCA, you don't understand our business. Here are all the good things that we do. Here are all our processes that control all of these issues. You don't understand what we do. The FCA goes, well, yes, I do understand what you do. And thank you for your undertaking in lieu, but I'm just going to ignore it. The real blow was they then referred the big consultants to the Competition Markets Authority. Now, in terms of scariness, I would perhaps describe the FCA as Homer Simpson. Makes a lot of noise, means well, doesn't always scare people. The Competition Markets Authority is a senior enforcer in the UK. It is Rambo. It is Arnold Schwarzenegger. And trust me, he will kill you. The Competition Markets Authority in the UK don't do consultations. They do investigations. And trust me, this investigation is a doozy. Every 2 weeks, a new working paper. Advisor research, asset manager research, consultant research, consumer research. No stone left unturned. They have challenged trustees. They have challenged the consultants. Now, whether consultants had just become very good at convincing trustees into mediocre choices, the jury is out. But be in no doubt that both the FCA and the CMA in the UK has put active fund selection on watch. It has put investment consulting on watch. And also, we expect those oligopolies to start to break down, because probably one of the most likely recommendations will be mandatory tendering of consultants, probably on a 3-year rotating basis. Right, the consultants can come back in now. That's good. So why is all this happening now? The destruction of trust and the hangover that's persisted for the last 10 years cannot be underestimated. Where finances truly become tested is in justifying its own economic value. So what is OEV? Well, you can think of it in the simplest sense as the alignment between the investor and their investment outcome. It's a piece of rope between those 2 points. How direct it is. How long is it? How many people are involved in it? Is there a tautness to that rope? Is there transparency? Where it's found lacking, we see immediately the symptoms across the globe. A move to passive, an ETF wave, fee transparency, criticism, indeed, of fund selection. In the UK, as a consequence of this, we're now going to see all UK fund boards move to the US fund board model with a minimum of 2 independent directors. You can guess what they're probably going to be charged to look at. Cost, value for money, etc., etc. The subtext is the worrying bit for me as a professional fund investor, because the subtext of all of this has been that active management doesn't work. Well, if the world's active managers are being criticized for not delivering excess returns globally, what does that mean for us as those who are charged to select those active asset managers?